Hi everyone, this is Anthony with the Calgary Real Estate Investor Hub. So today we'll be talking about how to calculate cash flow on your investment property. So first, we'll start with your rent, your gross rent. So you take the total amount that you're receiving on the property from all your different units, storage space, garage rentals, things like that. And then you want to subtract vacancy. Right now in Calgary, we use 3% for all numbers. Our current rental vacancy is actually 1%, but we like to add a little bit more because in a balanced rental market, 1% is not typical. Now, for yourself, you want to use a vacancy rate that's reasonable for your own market. So do some research and find out, do you need to go higher? Do you need to go lower? So once you subtract the vacancy from your gross rent, you will end up with your net rent. So that's the income that you're going to use to then figure out your cash flow. So first of all, we've got your mortgage payment. Now, a lot of people will stop here. Actually, they'll take the rents, they'll reduce they'll take out the mortgage amount, and they'll be like, oh, okay, well, my rents are $2,000 a month. I'm paying $1,500 for my mortgage a month. My cash flow is $500 a month, right? Not quite. There's a lot more expenses to cover. So you've got condo fees. Obviously, if you have a condo, if it's a freehold property, you don't need to worry about it. HOA fees. Some properties will have homeowner association fees. That's typical with newer suburb communities, but could be in some other areas as well. Sometimes it's fees for lake access, things like that are lumped into that. Then you've got property tax. It's pretty standard, right? Just take your yearly property tax divided by 12, and then you'll have your monthly property tax. Insurance. If you need to figure out how much insurance might cost you, and you don't have the property yet, I'd recommend using an online quote. Just get an online quote from an insurance company. At least it will give you a good ballpark number of how much you can expect to pay. Utilities. If the tenants don't pay their own utilities, then you want to make sure that you account for that. Repairs and maintenance. Now, there's a few ways to calculate repairs and maintenance. Some people use the percentage of rent method. Well, they'll take a percentage, let's say 3% of the rents, and that's going to be their allowance for repairs and maintenance. We don't personally like to do that because, in our opinion, typically the higher the rents, especially for a comparable property, the more renovated that property is, and often the less maintenance costs are associated with that property. For example, if you've got two properties that are very similar, one is fully original, one's fully renovated, the rents are going to be higher in the fully renovated one, but likely you've upgraded things like the furnace and some appliances and things like that. So the way we like to calculate repairs and maintenance is we look at the property, we look at the size of it, we look at the condition, when have the appliances been repaired, how many appliances do you have, how many units are on the property, is it suited, is it not suited? And then we apply an amount based on our personal experience over the long term of how much that property might cost you. Just to give an example, on a detached property in Calgary that's in a mostly original condition, but livable condition, and has a basement suite, we'll usually go with $250 to $300 a month. Obviously, that amount will vary, as I was saying, depending on the property. And then you want to look at property management. If you need to hire a property manager, typically in Calgary, those are going to be 10 to 12% of the gross rents. And for single family, and if it's a duplex, fourplex, especially in the fourplex space and above, you might start to get slightly cheaper rate, likely around the 8 to 10%. Now, if you're going to self-manage, we would still recommend you look at what your cash flow might look like if you hire a property manager. Just to give you an idea, if down the road you decide to hire a property manager, if you need to hire a property manager because you move out of country, things like that, at least you'll have an idea what your cash flow will look like. So once you've applied all these expenses, you'll be left with your average monthly cash flow. Now, this is an average. In practice, it will fluctuate, right? Some months will be negative, even if your average is cash flow positive. Some months will be positive, but this is an average over a long period of time. The idea is to try to figure out, if I'm going to hold that property for X amount of years, am I likely going to have to top up money to keep it afloat, or am I going to have some left over?